Barry, you write this week about the gradually, then suddenly.
That's right. Pulling a line from Hemingway's "The Sun Also Rises." How did you go broke? Gradually and then suddenly, and that's how the world changes, and lots of little things shift that are beneath our notice until suddenly there's no escaping them, and that's as true for finance as it is for technology. Things change slowly, and then all of a sudden you realize it's a new world. It's a totally different experience.
I remember Herman Valk, The Winds of War, the fiction that he so captured the reality of 1939 was very gradually, then suddenly. What does 2022 look like for investors to move gradually, then suddenly?
So what normally happens during a cycle, and I enjoyed listening to your prior guests talk about how opaque this cycle has been, and that seems to be the nature of these large financial crises or exogenous shocks like a pandemic. It partly operates as a reset, but it also accelerates what came before. So it's hard to tell, hey, are we in the middle of the cycle? Are we late in the cycle? So I understand the issue of being opaque. But what we've seen gradually happen is what happens every cycle. Markets begin a secular bull market, relatively inexpensive. And towards the end of that run, it could be anywhere from 10 to 20 years, they end up increasingly not cheap. They end up expensive. And so what we've seen over the past decade is home prices have gone up, stock prices have gone up, bond prices have gone up. There's so much capital sloshing around. Venture capital, private equity, they've become a little pricey. So people have been warning about diminished expected returns incorrectly for a decade, or that warning has not bore fruit. We're now going to be entering the phase where I think we should ratchet down our expectations about earnings, revenue growth, and performance in the market.
How much? I mean, how much are we looking at? Is this something that's going to really hamper those pensions that have been enjoying blockbuster returns this year?
So we've had very low rates that made the cost of capital and borrowing borrowing from clients to purchase your goods very inexpensive. There's lots of signs that that's starting to creep up. You guys know I'm in the transitory inflation camp, although there has been a reset in a lot of input costs, and the annual rate of gains, the second derivative that Tom was talking about, is likely to be modest, but modest from higher levels. So whether it's wages or cost of basic goods, especially a lot of metals, and I'm not even talking about rare earths and things that are hard to get a hold of, but all sorts of inputs that go into manufactured goods, plus semiconductors, all these things are going to cost a little more, even if they're not going to continue that delta, that second derivative. So that's going to take a little bit off of profits, and that's why I would think, I mean, I can't tell you what the market's going to do next year, but I can say with a pretty high degree of confidence, don't expect 2022 to be as powerful a move upwards as 2020 or even most of 2021
All right,
was.
so let's say a client comes to you and says, what should I expect in terms of returns? And you say gradually, then suddenly, and they say, okay, what are you talking about in percentage terms? Over the next decade, are you looking at an S&P that's got a 5% return on an annualized basis? Is it going to be lower than that? Are we going to be net, not growing at all? Or is this, just basically a little bit lower, and you're not going to see the big ups and downs because you've got a Fed that's got everyone's back?
Well, I don't know how long the Fed's going to have everyone's back. The expectation that eventually we will begin to see normalization of rates, which was the beginning until we had the pandemic, moving back towards, I don't even know what normal rates are today, 2.5%. Is that normal Fed funds rate? So if someone comes to us, we map out, here's what the next 10 to 20 years we should expect. We build in a 4% inflation number, which is wildly overestimated, so that the worst case scenario happens, and we're pretty comfortable that that's okay. I would rather not give a specific number that's guaranteed to be wrong. I would rather give a range. Over the past couple of years, people have been talking about, hey, forget 8 to 10%, look at 6 to 8%, and we've seen 14% a year. I don't see that going on very much further. I would expect us to be back in single-digit gains for the S&P 500 for the next couple of years. Now, GMO and other shops that are much more bearish than we are, they're looking for negative returns. And we've gone a long time without a real correction. We've gone a long time, other than the pandemic crash, without a real bear market. And so it wouldn't surprise me to see a couple of years in the next decade to run negative numbers. I'm hard pressed to see a decade of, I think GMO is -6, -7. That's a little too pessimistic. I'm much more optimistic than that.